Welcome to Invert That. In today's video, we're going to explore one of Warren Buffett and Charlie Munger's most practical investing ideas, the circle of competence. The purpose of this video is to understand why Buffett and Munger focused only on businesses they could understand, avoided difficult problems, ignored most opportunities, and believed that knowing the edge of your own knowledge is one of the greatest advantages in investing.
And it really is one of the powerful concepts we've ever looked at.
Oh, absolutely. And to kind of, translate that into how it actually feels in practice, I want you to imagine someone offers you an incredibly strange university exam.
Okay, I'm listening.
So the professor hands you this massive booklet, right? It's got 1,000 questions covering just every conceivable subject in the universe.
Like anything from quantum mechanics to, I don't know, baking.
Exactly. Quantum mechanics, 18th century French poetry, advanced macroeconomics, the whole deal. But there is a massive catch.
Which is?
You only get graded on the specific questions you choose to answer.
Oh, wow.
Yeah. There is zero penalty for leaving a question blank. So if you only know the answer to, say, 3 questions with absolute 100% certainty, it would be wildly irrational to guess on a 4th.
Right, because guessing introduces the risk of being wrong and ruining your perfect score.
Exactly. Yet in the financial markets, millions of people guess on that 4th, 5th, and 50th question every single day.
That framing really gets right to the core of the issue. We're basically exploring the mechanical advantage of extreme self-awareness.
Yeah.
Because when we comb through the sources for this deep dive, and we've got a mountain of them today, we're looking at decades of Berkshire Hathaway annual meeting transcripts, Warren Buffett's early partnership letters, the Berkshire shareholder letters, and of course Charlie Munger's incredibly granular Wesco financial letters.
The Wesco letters are just pure gold, honestly.
They really are. And through all of these, a very distinct philosophy emerges. It's a framework built entirely around the power of exclusion.
Right.
The foundational belief isn't that you need to acquire this vast, limitless knowledge to succeed. It's that whatever knowledge you do possess is functionally useless and honestly, potentially dangerous unless you draw a strict, unyielding boundary around it.
See, I want to push back on that initial premise right away.
Okay, go for it.
Because it runs counter to almost everything we are taught about, intellectual growth and ambition.
Right. The whole be a lifelong learner thing.
Exactly. The standard advice is to be a sponge, to learn a little bit about everything, diversify your knowledge base so you can adapt to any situation. I mean, if I'm an investor, shouldn't my primary goal be to expand the total area of my circle of competence as fast as humanly possible?
It seems intuitive, yeah. But Buffett actively rejects that approach.
Wait, really? He rejects learning more?
Well, not learning more, but prioritizing the size of the circle over its boundaries. In one of his Berkshire shareholder letters, Buffett explicitly writes that the size of your circle of competence is not very important. Knowing its boundaries, however, is vital.
Huh. The boundaries matter more than the area.
Exactly. Think about the geometry of it. A massive circle with a blurry, permeable perimeter is infinitely more dangerous than a tiny circle with a perimeter made of reinforced steel.
Because you don't know when you've crossed the line into stupidity.
Exactly. Say you have a really small circle, like you only deeply understand the economics of local car dealerships.
Okay.
If you stay rigidly within that boundary, you will consistently make sound decisions. But the moment you step half an inch outside that boundary into an area where you only sort of understand the dynamics, your risk profile just explodes.
Because you don't even know what variables to worry about at that point.
Exactly. You're blind to the risks.
You actually brought a fascinating piece of historical context to this in our research notes. This idea of boundary enforcement isn't just a quirky Omaha philosophy.
No, it goes way back.
Yeah, it has roots going back to the Great Depression. In a Berkshire shareholder letter, Buffett actually quotes a 1934 letter from the economist John Maynard Keynes.
Yes, the Keynes connection is critical here.
Which is wild because Keynes was managing a significant endowment at King's College, Cambridge at the time, right?
He was. And it's really worth noting that early in his career, Keynes tried to be a macroeconomic speculator. He tried to predict currency movements and global credit cycles.
Basically trying to predict the entire global machine.
Right. And who got severely burned doing that.
Yeah.
So by 1934, his philosophy had completely inverted.
Oh, fascinating.
Yeah. In the letter Buffett cites, Keynes wrote that it is a mistake to think one limits risk by spreading money around among enterprises about which one knows little.
Wow.
Keynes argued that true risk reduction comes from putting fairly large sums into 2 or 3 enterprises you thoroughly understand or where you trust the management completely.
That completely subverts modern financial advice.
Completely.
Because modern advice treats diversification as the ultimate holy grail of risk management. Buy an index fund or own 50 different stocks so that if one fails, you're protected.
Right, the whole don't put all your eggs in one basket theory.
Yeah, exactly. But Keynes, and by extension, Buffett, is saying that buying your 30th favorite idea actually makes you more vulnerable.
Exactly. Keynes pointed out that human knowledge and experience are strictly limited.
Right.
There are seldom more than 2 or 3 enterprises at any given time where an individual can genuinely feel entitled to put their full confidence.
That makes a lot of sense.
So when you force yourself to deploy capital into your 20th best idea just to check a box for diversification, you are structurally forcing yourself to step outside your circle of competence.
You're watering down your conviction with ignorance.
That is a great way to put it, yes.
I see the logic, I really do. But the psychological reality of enforcing that boundary, it's incredibly difficult.
Oh, it's agonizing.
Right. I mean, if you are sitting at a desk and watching everyone around you get rich on an obscure cryptocurrency or some complex foreign exchange trade involving the Russian ruble, the FOMO, the fear of missing out, is just a powerful biological drive.
It really is.
So how do Buffett and Munger actually police their own behavior to prevent that?
They rely on a mental mechanism that is incredibly blunt. They call it the too hard pile.
The too hard pile. I love that. Like a literal inbox on a desk.
Basically. During the 1999 Berkshire Hathaway annual meeting, Charlie Munger spent considerable time discussing this filtering process. He told the audience that they filter out a staggering number of investment opportunities simply because they classify them as too hard.
So it's not enough for an idea to just be highly profitable or widely celebrated by Wall Street.
Not at all. Munger explicitly stated, and I'll quote this, "We have to have an idea that is A, a good idea, and B, a good idea that we can understand."
It's so simple, but so rare.
He acknowledged that this filter serves to protect them against the consequences of their own lack of talent.
It's a brilliant ego check.
Totally.
If you're listening to this on your commute right now, think about the last time you felt pressured to have an opinion on a complex geopolitical event or, the structural shifts in artificial intelligence hardware.
People feel like they have to have a take on everything.
Right. What if you just looked at the situation, realized it was immensely complicated, and said, I have absolutely no idea, and I refuse to play a game where I'm the sucker at the table?
That is exactly what they do. In the 1994 annual meeting, Buffett admitted to his own shareholders that he didn't know how to evaluate financial instruments based on cocoa beans or the Russian ruble.
He just flat out said he didn't know.
Yeah, he wasn't embarrassed by it at all. He wore it as armor. Acknowledging ignorance isn't a vulnerability in this framework.
Right.
It is the primary defense mechanism against catastrophic loss.
And that defense mechanism shapes everything they do, which kind of brings us to a critical threshold in their philosophy.
That's fair.
If their entire goal is to define the boundary of their competence, we have to look at the specific characteristics that push a business into that too hard pile.
Yes. Based on the transcripts and letters, the most consistent red flag for them is complexity.
Complexity?
Yeah, they have a visceral, almost allergic reaction to complex business models.
See, I have a hard time reconciling this aversion to complexity with the way the world generally rewards effort.
How do you mean?
Well, let me play devil's advocate here. In medicine, the neurosurgeon who performs the most complex procedures gets paid the most.
Right.
In engineering, the team that solves the hardest aerospace equations gets the biggest contracts. We are culturally conditioned to believe that high reward is inextricably linked to high difficulty.
It's a very deeply ingrained idea.
Doesn't the market reward investors who solve the most complex financial puzzles?
You would think so, but the source material vigorously dismantles that assumption.
Really?
Yeah. During the 1994 Berkshire Hathaway annual meeting, Buffett addressed this exact mental model. He told the shareholders that you do not have to do exceptional things to get exceptional results.
Okay.
He used an unforgettable visual analogy. He stated that in the investment world, jumping over a 7-foot bar doesn't get you a better ribbon than stepping over a 1-foot bar.
Wow, jumping a 7-foot bar doesn't get a better ribbon. So the market is completely blind to your degree of difficulty.
Completely blind.
If you make $1 million solving a massive multivariable distressed debt restructuring, it spends exactly the same as $1 million made from buying a local chain of car washes.
Exactly the same. There are 0 bonus points for intellectual gymnastics
None whatsoever.
because there is no premium paid for unnecessary difficulty. Buffett and Munger actively and exclusively hunt for one-foot bars.
Which makes perfect sense when you frame it that way.
When you read the Berkshire shareholder letters, Buffett outlines his ideal criteria for buying a business. It's a very strict checklist.
What's on it?
Well, he looks for large purchases, demonstrated consistent earning power, and businesses earning good returns on equity while employing little or no debt.
Okay, sounds solid.
But the non-negotiable anchor is point number 5, simple businesses.
Simple businesses.
He writes, with total clarity, if there's lots of technology, we won't understand it. He explicitly rules out turnaround situations.
You know, we should probably pause here and explain return on equity, or ROE, because it's a piece of jargon that pops up constantly in these letters.
Yeah, that's a good idea. It anchors what they consider a simple business.
Right. So in plain English, return on equity is just a measure of how efficiently a company generates profit from the money its owners have invested into it.
Simple enough.
So if I start a lemonade stand with $100 my own money, and at the end of the year the stand generates $20 in pure profit, my return on equity is 20%.
Exactly.
Buffett loves businesses with high ROE because it means the business doesn't need to constantly suck in massive amounts of new cash just to stay afloat. It funds its own growth.
That is a crucial mechanical distinction. A simple business with a high return on equity is a self-sustaining machine.
Right.
But the moment you introduce immense complexity, like rapid technological shifts or unpredictable consumer trends, that return on equity becomes wildly unstable.
Because suddenly I have to pour more money into the lemonade stand just to buy the newest high-tech juicer to keep up with the competitor across the street.
Exactly. And that destroys your profit margins.
Yeah, that makes sense.
This aversion to difficult math is a recurring joke between them, actually. In that same 1994 meeting, Buffett remarked that if something is incredibly hard to figure out, they'd rather multiply by 3 than by pi.
That's hilarious because pi goes on forever.
Right.
It requires extreme precision to use accurately in complex geometry. Multiplying by 3 is a second-grade math problem.
Munger followed up Buffett's comment by noting that you don't have to hire out your thinking if you keep things simple.
Oh, that's a huge point.
Right. If you are looking at a business model and you need a team of highly specialized consultants to explain the supply chain logistics and the derivative exposure to you, the game is already over.
You've lost your edge.
Let's ground this in a real-world example of a 7-foot bar from their perspective.
Okay, let's do it.
During the 1998 annual meeting, they had a lengthy discussion about inherent business risk. The audience was asking how they evaluate risk independent of a company's debt levels.
And what did they say?
Buffett pointed to commercial aircraft manufacturing companies like Boeing or Airbus as the ultimate example of a complex, risky business.
Okay, let's look at the mechanics of that industry.
Right. To build a new commercial airliner, a company has to sink billions of dollars into research, development, aerodynamics, and massive manufacturing tooling.
And all of that capital expenditure happens a decade before the first plane even rolls off the assembly line.
Exactly.
You are spending billions today based on a wild guess of what global airline travel demand will look like 10 years from now.
Plus, you face immense regulatory hurdles, certification delays, and the threat of catastrophic design flaws.
Yeah.
If the economy tanks and major airlines suddenly cancel their orders or a competitor develops a slightly more fuel-efficient engine, you are left holding a multi-billion-dollar bag. The lead times are agonizingly long, the capital requirements are staggering, and the future is entirely opaque. Buffett categorized this as bet your company risk.
So that's the 7-foot bar. Compare that to the ultimate 1-foot bar in the Berkshire portfolio. See's Candies.
Perfect contrast.
See's makes boxed chocolates. The product essentially hasn't changed in 50 years.
No research and development needed.
Right. They don't have to spend billions on R&D to invent a faster, more aerodynamic peanut brittle.
Which is good, because I don't think aerodynamic peanut brittle sounds very appetizing.
Right. People's biological desire for sugar and chocolate is permanently hardwired. See's requires almost zero capital expenditure to grow.
And because people associate the brand with holiday traditions, they can raise the price of a box of chocolate slightly every single year without losing customers.
Exactly. Stepping over a 1-foot bar isn't just about being lazy. It is a structural mechanism for eliminating variables that can destroy your wealth.
That contrast between the commercial airliner and the candy company perfectly isolates the variable they care about most:
Predictability.
Predictability.
Yes.
Yeah.
But, this philosophy faces an enormous historical stress test when we look at the late 1990s.
That's the dot-com bubble.
Yeah. Stepping over 1-foot bars is easy to preach in a vacuum. But Buffett and Munger maintained this stance right through the biggest, most aggressive wealth creation event of the modern era.
We really have to paint a picture of the late 90s to understand the pressure they were under. This wasn't just a bull market. It was a cultural hysteria.
Yeah,
You had companies with zero revenue going public and achieving billion-dollar valuations overnight. Retail investors were quitting their jobs to day trade tech stocks.
Everyone was a genius suddenly.
Every major institutional investor, every magazine cover, every pundit on financial television was screaming that the world had fundamentally changed. A new economy had arrived.
And here are two of the smartest capital allocators in history, sitting on a mountain of cash, completely ignoring companies like Microsoft, Intel, and early internet infrastructure plays.
Just watching it happen.
It looks from the outside like an astonishing failure of imagination. If your philosophy forces you to miss the internet, is the philosophy broken?
It is the most intense criticism they have ever faced. And the transcripts from the 1999 and 2000 annual meetings are fascinating because you can actually feel the tension in the room.
The shareholders were restless, I imagine.
Oh, incredibly. People in the audience were essentially demanding that they allocate just 10% of Berkshire's capital into technology, which was viewed as the only play in town.
Just 10%.
Yeah, but Buffett and Munger refused to flinch. They held absolute ironclad firmness to their circle of competence.
Were they just being Luddites? Was it pride preventing them from adapting to a computer-driven world?
Not at all. Buffett went out of his way to clarify that it was not a religious belief against technology. They weren't anti-progress.
Okay, so what was it?
It was a cold, unsentimental admission of their own analytical limitations.
Interesting.
Buffett used a powerful analogy during those meetings. He explained that when he evaluates a business, he is essentially trying to predict what the bush will look like in 10 years and how many birds will be inside it.
The old bird in the hand is worth 2 in the bush.
Exactly. When he looked at technology companies, he flatly admitted that he possessed no ability to foresee what that bush would look like a decade out.
Because the landscape was shifting beneath his feet every 6 months. He couldn't calculate the underlying value of the future cash flows.
Right. If you don't know who's going to win the war, you shouldn't be funding the armies.
That makes perfect sense. Let's connect this to the concept of the economic moat.
Good idea. In the 1999 meeting, a shareholder actually pointed out that Berkshire had purchased pharmaceutical stocks in 1993.
Which also require massive research and development.
Right. So the shareholder asked why they were so staunchly avoiding tech if they bought pharma.
And what did Buffett say?
Buffett's response highlighted the difference in predictable dominance. He explained that it's significantly easier to predict the relative strength Coca-Cola will command in the global soft drink market a decade from now than it is to predict the relative strength Microsoft will command in the software industry.
Which is a profound shift in perspective.
It really is.
Because for a venture capitalist, rapid change is the opportunity. Disruption is the product. But for Buffett and Munger, rapid change is an existential threat. They are looking for businesses that are largely immune to disruption.
They want a business that looks exactly the same today as it will in 20 years.
That's the dream for them.
Buffett actually brought up an incredible historical point regarding IBM in those meetings.
Oh, I remember this.
He noted that IBM owned a massive piece of Intel and chose to sell it in the mid-1980s.
Which seems crazy in hindsight.
Right, but his underlying point was devastating. He said, if the brilliant insiders at IBM, the absolute titans of the technology world at the time, couldn't accurately forecast the future value of Intel, what level of arrogance would it require for Warren Buffett and Charlie Munger to think they could?
Wow. That is a phenomenal point.
It really grounds the whole philosophy.
Munger's commentary during the 1998 meeting regarding the internet boom is also essential listening. He had a way of just cutting through the hysteria.
He always does.
Yeah.
He didn't deny the technological marvel of the internet, though.
No, not at all. Munger fully acknowledged that the internet was a profound, legitimate development that would have massive, long-lasting consequences for society.
His issue was the speculative frenzy that attached itself to the technology.
Right. He warned the audience, and this is a great quote, if you mix the mathematics of the chain letter or the Ponzi scheme with some legitimate development, you are mixing something which is wretched with something that has very good consequences.
And then he delivered one of the most famous analogies in Berkshire history.
Yes. He said, if you mix raisins with turds, they're still turds.
And I love that Buffett immediately fired back. That's why they have me write the annual report.
It's a hilarious exchange, but the underlying lesson is vital.
Absolutely.
If you are listening to this and analyzing your own career or investment portfolio, the lesson is not to blindly avoid the technology sector.
Right. If you are a software architect who intimately understands the competitive dynamics of cloud computing infrastructure, that space might sit squarely inside your circle of competence.
Exactly. The universal principle here is that you must avoid playing any game where you cannot confidently project the outcome over a 10-year horizon.
Yes.
If the variables are too chaotic for your specific brain to process, walk away.
As Buffett summarized it, there are undoubtedly people who will make vast fortunes understanding complex tech businesses. But he and Charlie did not possess that specific insight.
And spending years trying to acquire it from scratch would be a colossal misallocation of their time.
They preferred to just stand at the plate and wait for the slow, predictable pitches they knew they could hit.
But you know, if projecting the outcome of complex, rapidly evolving businesses over a 10-year horizon is functionally impossible, who is buying the mountain of predictive models that Wall Street churns out daily?
Well, plenty of people, unfortunately.
Right. If you log into any brokerage account right now, you can find a highly credentialed analyst producing a 300-page report forecasting the exact earnings per share of a semiconductor company in the year 2030.
It's wild.
This exposes a massive rift between how Wall Street operates and how the circle of competence philosophy operates.
It does. When you synthesize the annual meetings and the shareholder letters, one of the most aggressive recurring themes is their absolute disdain for the illusion of precision.
The illusion of precision.
Yes. They view complex financial projections not just as inaccurate, but as actively harmful to the investor.
I have to play the skeptic again here, because modern finance is entirely built upon complex mathematics.
It is.
We have supercomputers calculating risk. We use modern portfolio theory. We rely on the capital asset pricing model, or CAPM. We use beta to measure volatility. Surely, sophisticated academic mathematics can manage the uncertainty of the future.
Oh, man. If you mention modern portfolio theory in front of Charlie Munger, you will trigger an intellectual avalanche.
I can only imagine.
Modern portfolio theory, at its core, is an academic framework that argues investors can construct an optimal portfolio that maximizes returns for a given level of risk.
Okay, sounds reasonable on paper.
But the fatal flaw, according to Buffett and Munger, is how the academics define risk. Wall Street and academia define risk largely as price volatility. They use a metric called beta.
Let's define beta clearly for anyone who hasn't suffered through Finance 101.
Please do.
Beta is essentially a measure of how much a specific stock's price bounces around compared to the broader market. So if the overall stock market drops by 10% and your stock historically drops by 20% in that same scenario, it has a high beta. Wall Street looks at that bouncing price and labels the stock highly risky.
Exactly. But Buffett and Munger argue that equating price volatility with true business risk is a catastrophic error.
Why?
In a Berkshire Hathaway shareholder letter, Buffett issued a famous warning. He said, "Beware of geeks bearing formulas."
Geeks bearing formulas, that's great.
He urged investors to be deeply skeptical of history-based models constructed by a nerdy-sounding priesthood using esoteric terms such as beta, gamma, sigma, and the like.
So he just dismisses the whole Greek alphabet of finance.
Completely. To Buffett, a drop in a stock's price doesn't increase risk. If the underlying business is sound, a drop in price actually reduces risk because you can buy more of it at a wider margin of safety.
Right. If a house you want to buy suddenly drops in price by 20%, you don't think it's riskier. You think it's a better deal.
It's exactly. During the 1995 annual meeting, Munger took a blowtorch to modern portfolio theory. He didn't just disagree with it, he called it twaddle.
Twaddle.
He went on a spectacular rant, stating that he is a student of human dementia, and while he can usually classify different types of cognitive decline, modern portfolio theory involves a type of dementia he can't even classify.
That is savage.
It really is. The reason they are so violently opposed to these models isn't just that the math is flawed. It's that the math provides a false sense of security while completely ignoring human nature and incentive structures.
That's a key point, human nature.
Right. During the 1994 annual meeting, Munger quoted Mark Twain, who famously said, "A mine is a hole in the ground owned by a liar."
Wow. And how did Munger relate that to finance?
Munger drew a direct parallel between that mind and modern financial projections.
Okay, unpack that for me.
Munger explained that long-term projections are almost exclusively constructed by people who have a vested financial interest in a specific outcome.
Oh, of course.
If an investment banker is trying to sell a corporate merger, they will inevitably build a mathematical model that proves the merger is a brilliant idea.
Because they get a massive fee if the deal goes through.
Exactly. And if a CEO is trying to inflate their stock options, they will produce projections showing massive future growth. Munger argues that the subconscious bias built into the creation of the model completely nullifies its apparent mathematical precision.
It looks like science, but it's actually salesmanship.
Beautifully said, yes.
And Buffett details in the shareholder letters how these lofty projections actually corrode the operational behavior of the business itself.
That's the scariest part.
Right. Because when a CEO issues a highly precise earnings projection to appease Wall Street analysts, they put themselves in a trap.
A huge trap.
If the business hits a macroeconomic speed bump, like a recession, or a supply chain shock, the CEO is faced with a choice. They can admit they missed the projection and watch their stock crash, or they can start engaging in accounting shenanigans.
And we know which one they usually choose.
Yeah. They start moving earnings from one quarter to another, pulling future revenues forward, hiding current expenses. Buffett warns that this behavior snowballs rapidly.
It does.
What begins as aggressive accounting to meet a Wall Street model can quickly morph into outright corporate fraud. We saw this exact dynamic play out with Enron.
Enron was the poster child for the illusion of precision.
Absolutely. They used mark-to-market accounting to project future profits from complex energy contracts and booked that future unearned cash as current revenue.
It was essentially legal fiction.
And their financial footnotes were an impenetrable labyrinth of jargon. Buffett explicitly warned about this. He advises that if you are reading an annual report and the footnotes are unintelligible, it usually indicates untrustworthy management.
If the CEO doesn't want you to understand the math, they will bury it in complexity.
As Buffett memorably phrased it, more money has been stolen with the point of a pen than at the point of a gun.
That is such a profound quote. And it brings us to another insight about using historical data to predict the future.
Right, the backtesting issue.
Wall Street models inherently rely on backtesting. They look at how variables interacted in the past to predict how they will interact tomorrow.
Which assumes the world doesn't change.
Right. In one of the letters, Buffett discusses the extreme danger of this approach. He points out the fallacy of projecting the historical loss rates of non-insured bonds onto a new universe of insured bonds, assuming human behavior and market dynamics will remain static.
He delivered a lethal critique of backtesting in that letter. He noted that if merely looking up past financial data could tell you what the future holds, the Forbes 400 would consist entirely of librarians.
Oh, I love that line.
It's so true, though. The past does not perfectly predict the future in complex human systems.
Exactly. To Wall Street, risk is the standard deviation of a stock price chart. To Buffett and Munger, business risk is a definitive gonna-go valve.
Meaning?
Risk means there is a substantial, unquantifiable chance that the fundamental economic engine of the business will permanently deteriorate.
Right.
If they cannot firmly assess that probability within their circle of competence, the investment is rejected immediately, regardless of what the CAPM model suggests.
Okay, so we have established a massive list of exclusionary filters here.
It's a very long list.
They eliminate complex businesses, they eliminate fast-changing industries like technology, they discard Wall Street projections, they ignore beta, they throw out academic pricing models.
Yeah.
To the casual observer, it looks like they have said no to 99% of the global economy.
Pretty much.
So how do they ever actually deploy capital? When a rare opportunity finally survives all of these filters and lands squarely inside their circle of competence, what is the trigger mechanism?
That is the ultimate question of capital allocation.
Uh-huh.
Once a business passes through the gauntlet and proves it is simple, predictable, and understandable, the final decision is governed by a mental model known as opportunity cost.
Opportunity cost. The way they deploy capital actually reminds me of the hunting behavior of a cheetah.
Oh, I like this analogy. Go on.
So a cheetah doesn't run around the savannah chasing every single rabbit or gazelle that catches its eye, right?
Right. It would exhaust itself.
Exactly. It spends 99% of its time resting, observing, and conserving energy. It waits until a highly specific, vulnerable, and slow-moving prey wanders into its exact strike zone.
Yes.
And when that happens, the cheetah abandons its passivity and expends all of its stored energy in one violent, massive sprint.
That analogy perfectly captures the rhythm of Berkshire Hathaway. Long periods of intense boredom punctuated by moments of extreme aggressive action.
Right.
During the 1996 annual meeting, Munger articulated the opportunity cost filter with absolute clarity. He explained that if you currently possess one opportunity that is available in large quantities, and you objectively like it better than 98% of the other things you see, you can simply screen out the other 98% without a second thought.
It is the ultimate intellectual shortcut. You don't have to evaluate every single stock on the New York Stock Exchange.
No, you don't.
If Berkshire already owns a wholly owned business that reliably generates a 10% return on capital year after year, any new investment idea has to be demonstrably superior to that baseline.
Exactly. If an analyst pitches a complex turnaround story with a theoretical 8% return, Buffett doesn't need to spend 3 weeks analyzing the spreadsheet.
The opportunity cost filter kills the idea in 5 seconds.
And when an idea does clear that incredibly high hurdle, their behavior radically changes.
They don't just take a small, tentative position.
No, they act in massive scale. We see one of the most vivid illustrations of this in Charlie Munger's Wesco financial letters from 1995 and 1996, detailing their investment in Freddie Mac.
Let's unpack the Freddie Mac story because it requires understanding a bit of financial architecture.
It does.
So Wesco Financial was a subsidiary of Berkshire, and Wesco owned a former savings and loan subsidiary called Mutual Savings.
Right. And to understand why this was a one-foot bar for Munger, we have to understand the savings and loan, or S&L, industry.
Okay, let's break it down.
Traditionally, an S&L takes in deposits from local customers and uses that money to write mortgages for local home buyers. It's a very simple spread business.
You borrow at 3% from depositors, lend at 6% to home buyers, and keep the difference.
Exactly. But because Mutual Savings was an S&L, it was legally permitted to own shares of the Federal Home Loan Mortgage Corporation, which is commonly known as Freddie Mac.
Okay, and Freddie Mac operates in the secondary mortgage market.
Right. They don't originate loans directly to home buyers.
Instead, they buy thousands of mortgages from local banks, package them together, guarantee the payment stream, and sell them to large investors.
Yes. They essentially act as a giant toll booth in the American housing market, taking a small, incredibly predictable fee for providing liquidity.
And crucially, they operated with an implicit guarantee from the U.S. government, giving them an insurmountable funding advantage.
Exactly. So for Munger, who deeply understood the mechanics of the mortgage industry through mutual savings, Freddie Mac was the ultimate one-foot bar.
It was simple, dominant, and predictable.
It was a simple business, dominating a massive market, with predictable cash flows and an impenetrable moat. So when the stock price dropped due to some temporary market fears, Munger didn't just dip his toe in.
What did you do?
Mutual Savings purchased 7.2 million shares of Freddie Mac for $71.7 million.
In the mid-1990s, for a subsidiary of that size, committing $72 million to a single idea was a monstrous concentration of capital.
It was an all-in sprint. In the subsequent Wesco letters, Munger tracks the result of that conviction.
How did it play out?
By the end of 1995, that initial $71 million holding had a market value of over $600 million.
Wow.
And by 1998, it had ballooned to $1.9 billion.
That is staggering.
Munger wrote in the letters that this staggering outcome confirmed a long-held notion of theirs regarding capital allocation.
What was the specific lesson he derived from it?
Munger wrote that being prepared, on a few occasions in a lifetime, to act promptly and in massive scale on some simple and logical thing will often be enough to make the financial results of that entire lifetime quite satisfactory.
Act promptly and in scale.
Yes.
When the pitch finally arrives exactly where you want it, right over the middle of the plate, you do not bunt. You don't swing for a single. You grip the bat and swing with everything you have.
But this behavior, concentrating massive amounts of capital into a single idea, requires a complete rejection of academic risk models.
Right. Because a finance professor would look at that Freddie Mac purchase and declare it insanely risky due to the lack of diversification.
Exactly. Buffett and Munger counter that if you have found a rare, mathematically obvious opportunity that sits firmly within your circle of competence, failing to bet heavily is the actual irrational behavior.
That makes a ton of sense. We see this embrace of concentrated, calculated bets even more clearly in their super catastrophe or super cat reinsurance business.
Oh yes, the supercat business.
Munger details this extensively in the Wesco letters, and on the surface, it sounds like the most reckless business imaginable for two guys who claim to hate risk.
It really does sound contradictory at first glance. So Wesco's insurance subsidiary, WesEc, entered the supercat reinsurance market. To explain this simply, reinsurance is essentially insurance for insurance companies.
Right.
If a massive hurricane hits Florida, a local insurance company might face so many claims that it would go bankrupt.
Because everyone's roof gets blown off at the exact same time.
Exactly. To prevent that, the local company buys a policy from a giant reinsurer like Berkshire Hathaway to cover the catastrophic worst-case scenarios.
So Berkshire is acting as the ultimate financial backstop.
Yes, they are taking on the risk of mega disasters, earthquakes in California, Category 5 hurricanes events that cause billions of dollars in damage.
Which sounds terrifying.
Munger writes in the letters that this business is not for the faint of heart. He explicitly warns shareholders that huge variations in annual results, including horrible losses in some years, are absolutely inevitable.
So the obvious question is, if their entire philosophy is built on predictability and avoiding complex risks, why would they willingly enter a business where they mathematically guarantee they will suffer horrible losses in certain years?
It seems crazy.
How does that possibly fit inside the circle of competence?
It fundamentally comes down to how they differentiate between short-term volatility and long-term mathematical probability.
Okay, unpack that.
During the 1994 annual meeting, Buffett addressed the supercat business. He explained that they are perfectly willing to lose massive amounts of money on a given transaction or in a specific calendar year.
Because they know a hurricane will eventually hit.
Exactly. The risk in their minds is not that they suffer a loss in year 3 or year 7. Their time horizon isn't a year, it's a decade.
Ah, okay.
Buffett stated that if they can price the insurance premiums so that the mathematical probabilities favor them over a 10-year cycle, they do not view it as a risky business at all.
They might lose $1 billion in year 3, but they will collect $2 billion in premiums over the other 9 years.
Exactly. He noted that the academic financial world has gone completely haywire by defining risk as yearly volatility.
Right. If a business swings wildly between plus 20% and minus 10% returns, academics call it highly risky.
But if a treasury bond returns a flat 3% every single year, academics call it safe.
Even if inflation is 4% and you're guaranteed to lose purchasing power.
Exactly. Buffett thinks that framework is fundamentally broken. If the underlying math of the supercat business guarantees a massive profit over a decade, you embrace the short-term volatility, you write the giant policies, and you let the probabilities play out.
We try and think like Fermat and Pascal as if they'd never heard of modern finance theory.
I love that quote.
Yeah, that was Munger's brilliant line from that same meeting. Pierre de Fermat and Blaise Pascal were the mathematicians who essentially invented probability theory in the 1600s.
Right. Munger's saying they don't need supercomputers or beta coefficients. They rely on basic probability, extreme discipline, and the patience to wait out the variance.
And that is the ultimate synthesis of the circle of competence.
It really is.
You don't need 100 brilliant insights in your lifetime. You don't need to constantly trade or react to every macroeconomic headline or possess a highly informed opinion on the future of every emerging industry.
You really don't.
What you need is the patience to sit quietly and wait for a few absolute no-brainers that sit squarely inside your specific realm of understanding.
And when they finally materialize, you need the courage to act with overwhelming scale.
So let's bring this all together. We have journeyed through decades of financial history today.
We covered a lot of ground.
We started by defining the true nature of the circle of competence, understanding that the size of your knowledge base is irrelevant compared to the discipline of knowing exactly where its boundary lies.
Right.
We explored the protective power of the too hard pile and why stepping over 1-foot bars is vastly superior to chasing the glory of clearing 7-foot hurdles.
We examine how this rigorous discipline kept them safely on the sidelines during the speculative frenzy of the late 90s tech boom.
They ignored the cultural pressure to chase complex growth because they honestly admitted they couldn't predict the long-term cash flows of the industry.
Exactly. They chose instead to avoid the traps of false precision, academic modeling, and the manipulated projections of Wall Street analysts.
And finally, we saw how the machine actually strikes. By using opportunity cost to ruthlessly filter out mediocre ideas, they conserve their capital and mental energy for the rare moments when a business they deeply understand becomes available.
And when it does, whether it's a massive stake in Freddie Mac or writing super catastrophe insurance policies, they act promptly and in massive scale.
If we pull back from the world of high finance, I want to leave you with a framework to apply this to your own life.
Yeah, this isn't just about stocks.
The circle of competence is a universal operating system. Look at your career trajectory. Look at the arguments you get dragged into on social media. Look at the side hustles or entrepreneurial ventures you contemplate starting.
Ask yourself a very blunt question.
Are you playing a game where you possess a genuine structural advantage based on your unique knowledge and temperament? Or are you exhausting yourself trying to jump over a 7-foot bar just to prove to the rest of the world that you can?
It's a tough question to answer, honestly.
It is. But the lesson from Omaha is clear. Identify your specific edge, no matter how small it might be. Build a fortress around it. Stay fiercely within those walls and watch how much simpler and vastly more successful your decisions become.